Welcome to The Explainer. Today we're diving into a really fascinating story from this earnings season, Riskified's second quarter. This is one of those classic situations where the headline numbers tell one story, but Wall Street heard something completely different.
So, on the surface, everything looked pretty good. Riskified pulled in just over $81 million in revenue. That was a nice little beat over what analysts were calling for. And, a beat on the top line, that's usually exactly what you want to see.
But the market's reaction? Oof, it was absolutely brutal. The stock just cratered, dropping almost 16% on the day of the announcement. That's not a small dip, that's a full-on collapse.
And that, right there, is the big mystery we're going to solve today. You beat on revenue, but the stock gets hammered. So what gives? What did investors see under the hood that made them run for the exits? Let's get into it.
Okay, first things first. To figure this out, we have to start with the official numbers and see exactly how they stacked up against what everyone was expecting.
So here's the breakdown. Like we said, revenue came in a little hot, and their non-GAAP earnings per share, that came in at 2 cents, which was right on the money, exactly what the street expected. Looking at this, you'd think, okay, pretty standard quarter, no big deal. And honestly, the good news kept on coming. When you dig in, the company actually looks pretty solid operationally. I mean, this is their 7th quarter in a row of positive adjusted EBITDA. They're generating cash. They have a fortress balance sheet with almost $340 million in cash and zero debt. They even announced they're going to buy back $75 million worth of their own stock, which is usually a big sign of confidence from management.
But despite all those solid points, none of it seemed to matter. The market's decision was fast and it was harsh. We're not talking about a little bit of selling. This was a stampede.
And just look at the trading volume here. It was more than 5 times the average. That tells you this wasn't just a few people getting nervous. This was a massive, widespread move out of the stock. The bears were out in full force, and they were selling with conviction. Now, it's also really important to zoom out a bit. You see, this one-day drop didn't happen in a vacuum. Over the last year, while the rest of the software world was up almost 30%, Riskified was actually down. So investors were already a little bit wary, and this report, well, it just gave them the reason they needed to finally pull the trigger.
So what was it? What were these investors so focused on? If it wasn't the headline numbers, it had to be buried in the details. So let's look at the bear case. And it really starts with one of the most important metrics for any software company: profitability.
And there it is, the big one, gross margin. It dropped from 53% a year ago down to 50% this quarter. Now, a 3-point drop might not sound like a catastrophe, but in the software world, margin compression is a huge red flag. It basically means it's getting more expensive for them to make money. So why the drop? Well, it was a few things hitting at once. They're growing in new areas like money transfer, which is great, but those businesses have lower margins for now. On top of that, their revenue in the super important US market actually fell 11%, and their home category just collapsed. You wrap all of that up with overall revenue growth of just 3%, and suddenly the picture starts to look a whole lot darker. But hold on, management wasn't just sitting there defending the present. They were busy painting a picture of the future. They have a whole counter-narrative that's all about long-term strategy and some potentially huge new growth engines. So let's hear the bull case. A giant piece of their future story is this idea of agentic commerce. I know, it sounds like something out of science fiction, but this is the idea that pretty soon your AI assistant won't just recommend products, it'll actually go out and buy them for you. That's a whole new world of e-commerce, and Riskified wants to be the company that keeps it safe. And they're not just talking about it, they're making moves. The CEO, Ido Gell, made a big deal about a new partnership with a company called Human Security. The whole point is to get ahead of AI-powered fraud. So instead of seeing all this new AI complexity as a problem, they're framing it as a massive opportunity to become essential. And that's not the only thing the bulls are excited about, because while the US was weak, their international business was on fire. Asia Pacific was up around 40%, and Europe was up 23%. Plus, revenue from their brand new products more than doubled. So the bull argument is pretty clear. Let the new products and the international business carry the load while the US figures itself out. So here we are. It's a classic Wall Street tug-of-war. You've got the bears, who are laser-focused on the weak margins and slow growth right now. And you've got the bulls, who are looking past all that to a big strategic pivot down the road. So how do we balance these two stories? What's our take? Well, let's start with what the company itself is forecasting.
Their official guidance for the full year is basically unchanged. They're not signaling some kind of collapse. To me, that's a quiet sign of confidence. They're basically telling the market, hey, we've got this. The second half will be stable.
So, looking ahead, here are the things you absolutely have to watch. Number one with a bullet, can they get those gross margins back up? Management is promising they will, especially in Q4. Then you've got the holiday shopping season, which is always huge. And finally, we need to watch for any early signs that their big bet on AI and agentic commerce is actually starting to pay off.
Taking everything into account, we're landing on a rating of market perform. Look, the long-term story is really interesting, and you can't ignore that international growth. But right now, the market is firmly in show-me mode. It's not enough to talk about the future. Investors need to see the results. They need proof that margins are getting better and that growth is picking up speed before they're going to jump back in.
And as always, just a quick reminder, this is not financial advice.